Hello, thank you for participating today to our update webinar with Filippo Lanza, founder and portfolio manager of HI Numen Credit Fund. We think this is a very interesting moment to cover the macro view, of course, to cover on the volatility we have seen in the last couple of months, and also to better explain what happened to the performance of the fund lastly. So without waiting any more time, Filippo, I leave it to you. And so please go ahead.
Thank you, Laura, and thanks everybody for taking the time to listen to our update. The last couple of months, I would say probably more the last 4 or 5 weeks, have been quite volatile for the fund, and predominantly has been our positioning where we had long position in duration, especially long duration, especially in Europe, predicated on our view that the economy is slowing down, inflation is slowing down, and there is an increasing chance of some financial accident. That was also compounded by the fact that we had short positions, especially through put option on the equity market, and that didn't come to fruition, actually added to the negative performance. We remain of the same view, and the book is still positioned as it was before. We had the decent recovery beginning of the month, but obviously we want to walk you through our thinking, the reasoning, and some of the position we got. So on the first slide, we're talking about, obviously the economy has been incredibly strong despite the monetary tightening we've seen. A big chunk of that is because of the excessive savings that have been accumulated during COVID. For large chunk of population globally, savings being zero or negative most of the time. COVID was effectively a forced accumulation, and that effectively returned to meant there was a lot of consumption that kept the economy up. Those excessive savings are being used up, and actually we did the presentation a couple of days ago, but just today a representative of the Bank of England came up appeal saying that the excess savings in UK has been used up, his own words. So that's one first big engine of the economy that we see effectively spluttering or shutting down. As a reflection of that, obviously we're seeing inflation, especially in the five-year inflation, going down, and then we see a lot of the input on commodity even after the recent oil spike. They're coming under pressure. One big driver for the commodity consumption, as we know, has always been China. We always had and shared our negative view on China. There's not an economic miracle, it's simply a massive real estate bubble, which is going to be very painful to unwind, especially because it's sitting on an inverted demographic pyramid, where there's a lot of elderly people, very few young people, no immigration. So we think that is one of the reasons why we don't see structural inflation building up in terms of demand of input prices and consumption on that. If we can move to the next slide, obviously we looking at something which for us is going to be very, very pivotal, very consequential in the next few months. We are thinking from an asset allocator point of view, which is faced with different options, obviously different asset classes. We thought equity was overpriced and fixed income was underpriced, and that was the driver of our losses. But if we look at just a simple reallocation of US equities of 2% would basically fund 1 year of Fed quantitative tightening. And then similarly, if we had the reallocation 1% of global equity into global bonds, you would have 1 year of global QT. Now, typically, that sort of trade-off was not really present in the mind of many asset allocators. But now you have the ability to lock up some pretty interesting returns, especially if you think, as we do, that inflation is going to be on a downward slope, not much for the specific contextual driver, but more because of a long-term technological advance that we see as accelerating massively over the last 30 years. And we see we're just about to see this massive AI revolution, which will be incredibly deflationary. And so with that in mind, if I were an asset allocator having, a 3 to 7 years, at least time horizon, if not much longer, obviously there is a very compelling determination to be made between fixed income and equity. We think equity is really overpriced all across, and partially also is because if AI is deflation, AI is also a big competitive disruptor. There'll be plenty of startups where 1 or 2 million funding can be pretty impactful because of the new technology, and that obviously makes established business, typically the listed ones, more vulnerable in our view. If we move on to the next slide, we just want to give you an exemplification of the attractiveness of the entry point from our visual perspective. I typically have done a lot of stress distress in my life for the last 30 years. The rule of thumb, you never touch bond above 50. Now, if I look at the market now, we have AA, AAA countries with bonds running between 30 to 40, and that is a pretty attractive entry point. Because for some of the duration, some of the convexity, the profile you're getting, both in terms of current yield and upside, is pretty incredible. And that positioning fits well with our macroeconomic view, but also fits well with our, market structure view, which is we think there's a lot of leverage being built for the last 10 years in these markets. And we think the monetary effect, the cumulative lag effect, is going to be meaningful. And so there is an increasing chance of market accidents. We've seen it with Credit Suisse, with SVB, we've seen it recently with Metro in UK. This is just the beginning. And so we think because of that, eventually there will be a big turning point for some of the valuation on the fixed income side. At the same time, one big driver for us in our allocation, in our thinking, is it's going to be AI. And we think, one major beneficiary of AI is going to be the most, disorganized and structured monopoly business. And, the best in that list and the biggest are governments. And so because of that, we think, whether it's tax collection, whether it's, provision of services, whether it's payroll, we think the governments will be in a position where they will be able to reduce their expenses quite significantly. And that would add to the deflationary wave we see coming from AI. So we like those bonds. We think it's a great entry point. And if I look at the convexity, we try to give a visual representation of a movement between 100 basis point up or down. Obviously, these bonds are incredibly convex just because of the math profile, and just because we've seen the bonds at these levels are pretty incredible. He also adds a lot of degrees of freedom to governments if they ever want to do debt management, because there's a lot of talk about obviously the deficit and the debt over GDP, but we know banks and central banks are players. They've done it with QE, they can do it again. And if they can buy back bonds at below par, obviously it's going to impact on their debt GDP. We've seen it with Greece, we've seen it working with Greece, with Italy during the peak crisis. And then there is no reason why it wouldn't that work with US or France or UK in the future. If we can move on to the next slide. This is the slide we dedicate to QT. Obviously, QT has been a big driver for us. It's something that made us negative and bearish on bonds for the first part of the year, but we thought that we would have gone next to the kind of break-even levels, which was not, obviously we call it too early. But I think the QT we've seen obviously being quite aggressive on the US side and Europe side. But I think, again, that is something that we need to be prepared for central banks to be going back to that sort of tool as soon as needed. And that could be either triggered by a recession or a deflationary wave coming from AI, or some sort of financial accidents, as we've seen just 6 months ago with the SVB crisis that effectively triggered the Fed to initiate new QE kind of programs. If we could move to the next slide, obviously, we are trying to be discriminating in terms of macro risk. There are good and bad macro risk. China, for us, remain, a structural short. We don't think China is going to go back to the pre-COVID kind of economic generation. We think it's as the new political developments being going to be quite negative for growth. We think the demographic inverted pyramid is a structural feature of the economy and of the country that will not be able to escape that anytime soon. And we also think there is an enormous amount of real estate excess that still need to be unwound. The two things combined made China it's going to be a very exciting and unexciting player in terms of economic growth. So that will remain bearish, remain negative. We think China will have to use a lot of their reserves to effectively refinance and recapitalize their banking system. On the other side, obviously, we go UK, still a short. We think UK is a very vulnerable economy. Of all the real estate markets in the world, is the most exposed to short-term rates. And those have been shooting up over the last 12, 15 months. That will have a big impact, we think, on the economy. There obviously has been a lag effect. We will see the results, and we do expect a pretty strong contraction in the economy over the next 6 to 9 months. And that is something that we remain short, both through the sovereign, but also through the banks and from time to time on specific selected corporates. If we can move to the next slide, we now talk about special sits. There is a lot of special sits really involved, some on the macro, and in particular Ukraine and Argentina is something we suffered a bit over the last 6-7 weeks. We still like very much Ukraine. We think it's more likely that we're getting closer to the end rather than not in terms of the military confrontation with Russia. It's been a massive human tragedy on both sides, and we think there is increasing incentive on both parts and the relative allies behind them to kind of push for some sort of settlement. Obviously, there are positive and negative, events away from the mean. In terms of negative, obviously, and hopefully we'll never even have to think of that, but there is escalation and possibly nuclear accidents. In terms of the positive, obviously, you could have a situation where Russia has a change of leadership, and obviously there is presidential election next year, which are probably too underestimated by the market. So away from that, we see the economy as being quite robust, quite resilient. We think Ukraine is absolutely essential and existential for Europe. So we don't see any reason why Europe could ever, abandon them or reduce the support, because it just doesn't make rational sense for them. So we think the support will keep on coming. The economy is kind of resilient, and obviously there is a chance of a peace settlement or something. There is one thing to keep in mind, which is very, very important and is unique from an historical point of view. We never had a situation where you had, a military confrontation between two blocks, and one block could actually control the financial resources of the other. It's never been seen, ever, with the only exception of, if you want, Troy having Helen while the Greeks were coming. But I wouldn't compare that, but that's the only historical comparison that I can see. Why I'm saying that? I'm saying that because it's very important, because between US and Europe, they probably control between $500 billion to $1 trillion of assets, of Russian assets. So if I look at history, war reparation has always been a major issue of any settlement, and the repayment of war reparation eventually, or the failure to do so, has always been a trigger for new confrontation and new wars. In this instance, you have a situation where literally the Ukraine controls the financial resources of Russia. And I think that would be, as always, because money is very important in this kind of context, it would be a big driver for potential settlements, potential negotiation, but also in terms of the creditworthiness of Ukraine, could be very substantial in supporting them. So we look at Ukraine, we think there's a good chance that eventually we move into the, a little bit less than 50, into the 40s. Obviously, there is catastrophic development in the war, in which case, we could see the bonds collapsing. but within probability adjusted, we see much more upside than downside. Obviously, the bonds don't pay coupons, but I think, you know, there's going to be some sort of restructuring. I think the financial markets will be very supportive with Ukraine restructuring, and so we think is a good, and we think will be definitely an integral part of the European Union and NATO going forward. To move away from that, Argentina obviously has been on a roller coaster, a completely different picture. Argentina is probably one of the few beneficiaries of climate change, with El Nino coming, which should really support and help the agricultural prospects. They also have an increasing amount of lithium, oil and gas projects that could add value. Obviously, there's been a lot of reaction to Milei and his kind of, you know, threatened or kind of announced dollarization and removal of central banks. Milei is a bit of an orthodox, obviously, to understate his figure, but we think Argentina is pretty much already dollarized. So it doesn't really, the only difference between being fully dollarized and not is the ability for the governments to do excessive financing and budget deficit, which is what the previous administration have done for the last 20 years. We think there is a high chance he wins, but we think the prices now are probably pricing too much that he's going to win, and also is going to stay on his extremist position. We think eventually he will mellow, as every leader, as soon as they get to power. To govern, you will need to rely on a variety of political parties supporting him, among others, Macri. And we think, you know, the market could reprice significantly Argentina going forward. There is the risk, obviously, the thing gets disorderly. It pushes with dollarization and so on immediately. And then obviously you could see the bonds going into the 15, 20 kind of pre-default. On the other side, obviously, there is a decent upside if it kind of moves to the centrist stance. And even more upside could be triggered by the kind of context we see, where from next year we'll see plenty of deflationary pressure. Away from that, one special situation we see on the telecom is Telecom Italia. We've been discussing about that for some time. We think Vivendi has a little incentive to enter into a legal battle with the government, which actually can rely on golden powers, which are very extensive and very, very consequential as powers. And also because even if Vivendi were to win that war, the legal battle, then the board would resign, there will be a new management team, and presumably any new management team will come in and say, we have a problem with that, because it's highly levered, we need to do a capital increase. And in those kind of scenario, yeah, Vivendi would win to block the current deal, but he would actually end up with a massive dilution by capital increase, probably losing even more than what he thinks is giving up in terms of upside. So we think Vivendi is correctly negotiating with KKR, the government, and so on. And I think there is plenty of situation that they can address to transfer value. One is how much debt moves between the two companies and what kind of debt. Is a very complex debt capital structure. To the employees and which employees are going to go where. And then thirdly, the service master agreement, which is effectively the rental contract, the lease contract, whereby Telecom Italia will rent and will use the fixed network to sell its services. And obviously those three, they may not have enough degree of freedom to close the gap between 22, 23 billion and 31 that Vivendi talked about at the beginning of the process, but it's definitely enough to close that gap to a more meaningful and more manageable level. So we still think probably adjusted, there is upside due to the fact that we see the deal as progressing, although there could be some wobble as always, and as we had a couple of weeks ago. If we then move to Dish, is something that we have been involved quite a bit. Dish is effectively, it is a mixture of like legacy business with the kind of satellite TV, especially in the rural areas of America, but at the same time, they've been developing these completely brand new state-of-the-art 5G network in America. It's a national network where they are literally taking the latest technology, so there is no legacy. And we think the new network seems to be more efficient, more competitive than the others. And that could be very, very, very valuable. We think the bonds have been trading very low because it's effectively a one-man show to a certain extent, in the sense that the founder majority shareholder doesn't want to lose control. So obviously it's keeping a capital structure very levered. but we think there's been a few changes, there's been a merger with EchoStar that would provide enough cash for the business to bridge to the next year or two to then refinance properly. And we think that year and a half of breathing space should allow the business to prove that the new network is really good and is more competitive than the others, and so is attracting more value and more customers. We own this convertible around 57. We think there's a very decent chance the company will do well with their products, and they will then do well with the restructuring. So we have that position and been doing okay, being positive for the year like Telecom Italia. We think there is still there's potentially quite a lot of upside coming from here. If we move to the next one, this is an old story for some of the investors been with us for long, is Banco Espirito Santo. We think expropriated pretty badly in 2015. Obviously, there's been an ongoing litigation on that. We know that we are entitled to the non-creditor washed off out of the estate, and that is around 31. We own the bonds in the low 20s. That's where we have the mark. So there is decent upside, almost 40%, just on getting the non-creditor washed off. But obviously, we are positive on a proper form of settlement eventually from the government and the Central Bank of Portugal. We don't know if and when that will happen, but we feel confident that obviously if the speculation on the papers is correct, that Lone Star is looking to sell Novo Banco, which is a good bank, where both the government and the resolution fund in Portugal are shareholders. We think that could actually be a nice catalyst for some sort of settlement being done. The litigation progresses, and obviously there's been articles even on Bloomberg from some investors that actually think that there is quite a lot of upside. I mean, in the sense that if the investors were correct in some of their requests, they could actually get more than par. We don't want to be that optimistic, obviously, but we think this is something where we see some of the catalysts and triggers that could actually accelerate this process. So it's something that we obviously monitoring for the fund. Away from that, obviously, in general, we remain very excited about the credit market. We think there is a massive lag effect of monetary policy. There is a recession coming. There's very overvalued and over-leveraged capital structure around that would offer opportunity to us. There's a lot of names that we know, that we follow, that we study, but we don't have exposure to, and those typically are the best for us when it comes down to credit, single stories. We reacted to our pair. We did really well on that. Same on SVP, Credit Suisse, UBS. And we think and intend to do the same going forward. So we do expect quite a few other idiosyncratic blowout, and that's typically where we will be able to move, because as a fund, we remain very agile, we're very liquid, and we're very reactive to the kind of market flow, we will say. And
so we cover, all the main positions for the fund. If anyone has question, please use the chat. In the meanwhile, maybe Filippo, something we think is very important to address, if possible, today is what recently is happening in the Middle East. This could, of course, challenge the downward trajectory of inflation. So what do you think about this?
I think, obviously what's happening in the Middle East is tragic, and I think is unfortunately something that probably could have been to a certain extent predicted, because there never been a structural solution there, and so this thing is blowing out now in a context where actually until a few days ago there were expectations for normalization and a more orderly set of conditions there. The view from the market is at the moment is that as long as Israel will not engage other superpowers in the region, and obviously namely Iran, and vice versa, then this thing will remain once again an horrible set of human tragedy, where the most vulnerable and innocent people will be exposed on both sides, obviously. And that, I think, is the view of the market, and it's being reflected in the pricing. Equity index are probably up to 3% since the events happened, which is kind of, in a way, seems like a strong statement. At the same time, I'll be very cautious in believing the markets have some kind of ability to assess geopolitical events and their ramifications. I think what we're going to see now, unfortunately, is an escalation of the confrontation and the tragedies. And I think, obviously, if that impacts the oil supply, we will see a big jump in oil. But I think, the demand destruction associated with that will be way more than the inflation scare. So I think the economy is already slowing down significantly across, especially in Europe. I think that could be a hit too hard to manage. Having said that, I don't think we have Yom Kippur kind of 1973 scenario, because the dependency of the market and the economy to oil is much less. But obviously, we had a lot of substitution going through because of the Russian oil and gas. So it's obviously, hopefully we're not going to see it, but my concern is the market is very sanguine about the scenarios being very positive so far. So we will see when it happens. Obviously, inflation will be picking up, but I think the demand destruction will be brutal also because, unfortunately, since the 70s, the picture has changed dramatically. The military capability of all the players involved are unfortunately much more far-reaching and intense than what they had. So that means that if there is an escalation, it will be a lot more global in its impact than what it used to be. So we're watching it very carefully. We feel the market is being very, very optimistic so far. And I can only hope the market is correct this time. But rationally, I would guess, especially in the next few days, we may see situation to deteriorate, unfortunately.
Okay, we have a couple of questions. So the first one is, where do you expect the long end interest rate to go, both for US and Europe?
Yeah, I think Europe, we'll see what happens with the numbers, and obviously depending what's happening with assuming that the status quo, if we can call it like that, in the Middle East remains, because it's not really a status quo, but I would guess, I think Europe, especially, the 10-year bond, I think we can stay, we can probably hover down between, we reach a levels, I think we were at like almost 3%. Now I think, we'll probably stay closer or move closer to the 2.5 numbers, if things stay where they are. And the long end may actually, if the recession is as we expect, is quite substantial. I think the long end could actually outperform the 10-year. US obviously is different because obviously it's a much more active and reactive economy. So there, I think maybe we see a bit of a less pronounced movement. I think the 30-year was around 5. I think again, I think we're probably going to stay between the 4 and 5% on the 10-year. I don't think, we're going to shoot up massively, not at this point, not given what we see in the economy. Our view long term is that AI is going to come. It's going to be really, really impactful. We also think there's a very high chance of a financial accident, which then would completely stop central banks in their QT. I mean, the balance sheet is a tool the central banks will use all the time, and it's guaranteed. And the one thing they learn, as soon as things get bad, they'll go back to what they were doing, with the difference now that if you're a central bank buying bonds now is very much closer to when Trichet was buying Greek bonds at 50, 60, 70 cents on the dollar, or when Draghi was buying BTP in the 70s. i.e., it's much more impactful if you do it now when bond prices are much lower than when bond prices are way above par during the mad days of QE before. So overall, I think depends what's happening with the war, but I would guess we're probably going to be closer to the 4% in 10-year US over the next 6 months than the 5% on average, and similarly for Europe, between 2 and 3 on the 10-year will be closer to 2 than 3. we do expect a massive amount of AI companies projects to come online over the next 6-9 months, and that will be very, very deflationary.
Then the next question is, with respect to the financial credit, are you a buyer today? Do you think there is still a lot of value there?
Not particularly, actually. We had a big position on Monte Paschi that did really well, and then we sold all of it, just because we don't think credit now add enough premium for the liquidity and the fundamental risk that you need to carry. We don't particularly like banks now because we think we're going into a recession. So I think we've seen a lot of like good things, and actually, if anything, we've been running a few puts and shorts on banking index in Europe, because we think the recession is unavoidable. We think the way the ECB has structured the TPI and OMT sequence is actually making it a little bit less robust in the short term. The kind of protection they can afford to countries like Italy or other vulnerable country. So banks, we don't really like them here. Obviously we played a lot on the long side of the banks this year, UBS, Credit Suisse, Monte Paschi, and even on the equity side, actually after the crisis. As of now, we think we're very, very fully valued. If we believe what we believe, and we think it's gonna be a big issue, I think we're gonna see lots of credit defaults and credit risk coming up. And we see again the economy being very too sanguine. I think our idea on banks is to wait on the sideline if and when something happens.
Thank you. Then I think before closing, we should better address the attribution for the losses of September and October, even if the fund is coming back in October. So if you can just give a sense of how much came from the long duration positions or from other part of the portfolio, such as the special seats.
Yeah, the vast majority of the losses came from duration, as we wrote on the letter, and that was compounded also, and we recovered some of it, but we kept most of the position, so hopefully we have more space to recover there. Some of those losses in the macro were actually compounded also by call it macro, call it special seats, but by Ukraine and Argentina. Ukraine came down in pricing, and that happened over the end of September, beginning of October. I think there was a lot of pressure in Ukraine. Like I said, we really like it. We think there is plenty of upside there, so we kept all of that. Argentina, we've been more tactical. We lost some money there, but we reduced. But we're planning to probably increase towards the end of the year if and when the right political condition develop. And then obviously another driver of the loss has been the shorts we had on equity. We had quite a few put option on equity shorts because we thought there was this point of sort of asset reallocation into bond out of equity, but actually we saw a very strong equity market and a very, very weak fixed income market. So all of that included basically explain the vast majority of losses. On the special seats, we've been cutting down actually on overall, because we reduced completely Monte Paschi, which was a big position for us. We kept the others like Dish, Telecom Italia, we like them, but they've been a bit volatile, obviously inside with a bit of the market. But the vast majority by far, was all long duration.
So we might say that the most of the loss were not crystallized.
No, actually, as a matter of fact, we kept, we changed a couple of things between US and Europe, but we are running the long duration, and I think we like the entry points we got. We like the convexity, so yeah, we kept the most of it.
So just, I would say, just to conclude, of course, you have done it for many of the position, the probability, success result, the convexity of each position. Could you do it also for the fund? So where do you think, how do you think the fund is positioned today with respect to what we were seeing on the market, and so where do you see the probability standing for having a very good performance, or if there is more downside to come, how much could it be?
Well, I think we are positioned because we think obviously there is upside, and I think our position is predicated on the fact that we do expect pretty significant slowdown, especially in Europe. And we think, you know, equity especially is pretty priced for perfection now. Probably more US than Europe. I think in terms of the overall performance, obviously, you know, we have quite a few, you know, substantial special situations that could, you know, hopefully work our ways. In which case, you know, we should easily get into a positive performance for the year and above that. Obviously, you know, on the idiosyncratic side, there is always some, you know, independent event, so it's not necessarily predicated on the beta. On the macro, we think, you know, where we are is a pretty good entry point. We are meant to keep what we got, but obviously be very mindful, very attentive. But I think, you know, the overall positioning seems to be, you know, consistent with our view. We remain very liquid also, because at the end of the day, we think there's a decent chance of financial accidents. So we want to be prepared, whether it happens on the banking side or insurance or something else. We want to be able to play that. So we hope we're going to recover most of it via a combination of both macro and special sits, and then hopefully between, you know, some of the, you know, the position we are on already and some of the new, we should be, you know, adding significantly to the performance.
So thank you very much, Filippo. I think we cover most of it. Of course, we stay available for everyone if you have a follow-up question. Thank you for your time.
Thank you. Thanks, everybody. Have a good day. Thank you.